Hello, investor. Welcome to invest in SMSF. You all know that SMSF are about retirement, but here's the challenge. Would you rather tie your future to one house or spread it across thousands of companies worldwide? And my name is Ken. Today, we will argue that self-managed super funds should focus on equity rather than property. Why? This isn't small. This means a difference of hundreds of thousands of dollars when you retire. That's why we need to look at the evidence clearly. Equity and ETF give SMFs access to global market, efficient structure, and the compounding power of dividend and capital growth. You don't need a large amount of SMF to have a flexible plan strategies and able to choose stock inside or and outside the countries. The key thing is investor can head to long term compared to consistent income. Over decades, Australians equities return around 7.8% per year in real term compared to property 6.3%. Even in 2024, equities, including dividend, deliver 11.4%, while housing and rent just give 8.3%. ETF often charge as little as 0.1 to 0.3% annually. This ultra low cost keep more of your money compounding retirement, which means more of your money keep working for you instead of being eaten by management fees or hidden charge. This ultra low investment cost structures is the biggest reason why ETFs are recommended globally as the foundation of retirement portfolio.
Apart from Ken's perspective relating to equity, by contrast, I personally insist that investing SMSF in properties is a more efficient strategy, specifically in commercial properties. First, the business premises strategy. Investors can buy a commercial property through an SMSF, meaning the property is held and managed by the fund rather than by individuals directly. They can then lease it back to their own business. The monthly rental, treated as a business expense, flows back into the investor pocket, effectively reducing tax. According to Knight Frank, Sydney's monthly office rental in 2025 is about 1,484 Australian dollars per square meter, which can generate significant annual savings for businesses. Secondly, investing in properties can earn capital gains. As we can see from the house price chart, over 30 years of the six major Australian cities, house prices had a tendency to rise in all six cities. On the right-hand side, Sydney's house price has an average growth of 6% and approximately 4.4% for Melbourne. Nationally, the house price growth is about 6.7% annually, which is currently at its peak. Through these two indicators, we can conclude that the overall house price performance is growing and reaching its peak in Australia at the moment. Thirdly, property itself is a tangible asset. According to the RBA, when borrowing money from banks and financial institutions, loans secured by tangible assets appear to have a lower interest rate compared to other assets except physical ones. In other words, investing in a commercial property isn't just owning the real estate, but also gaining more opportunities for further leverages.
That was a great argument to show that equity is far more superior to property. And by the way, I'm Cheryl, and I will share this view with Ken. So having liquidity in retirement is crucial as you may need immediate capital to do something, or if you make a mistake in your investment. So in this case, based on the basic assumption that both assets goes down in the same value and the capital gain tax rate apply on SNSF, equity provide you with a lower capital loss when selling, as low as 0.15% if you invest domestically with a 2-day settlement period. But for property, getting out is a costly option. Selling costs can eat up to 5% or more of your capital. Not only that, even if you accept that cost, you have to wait 3 to 6 months to get your money. So with property, either you accept to wait for liquidation or eat the loss. And another benefit is having equity is franking credit, which is basically tax credit to avoid double taxation in dividend. So assume having an amount of income of $100 in cash dividend and net in rental income, which is already accounted for interest and expense. There will be a $42.86 franking credit on top of the $100 dividend, which is actually the 30% corporate tax that the company already paid before issuing the $100 dividend. So they will be passed out to the investor, and at the SMSS tax rate, The gap of 15% will leave the shareholder an extra $21.43 in receivable tax credit. And with property, diversify means that we only pick between suburb and stay for the best options. But in the end, we still subject to the same market with similar pattern and policies. On the other hand, diversify with equity means that you can invest in multiple industry and if needed invest in another market and they still have a lower cost than acquiring a new property. Or we can combine on the preference, so mix some ETF, dividend, and growth stock inside to mitigate the risk. And so with equity, you actually hold the game, not the other way around for property.
So you guys' affirmative team has highlighted equity with liquidity, tax benefits, and also diversification. But I think retirement investing is not just about like fast trades or chasing the tax benefits. I think it's more about like the long-term security, the stability, and also the dependable income. Yeah. So now let's dive deeper into the pros of property. But the first one is tangibility and stability. So we know that property, it's a physical asset. It's not just numbers on the screen, but it's something that we can see, we can touch, and also we can trust it. And according to the ASX, so the housing and property has outperformed the equity over most of the last 20 years, as we can see here in the graph. And also, unlike equities, the property is less volatile. It doesn't swing daily, not just like rise and fall every day or like in every minute. So it provides like a psychological comfort and peace of mind for the SMSF members as investors. And also like owning something real, brick and mortar, as I mentioned here. So it's like a wealth building tool that most Australians truly believe in because it's reassuring during uncertainties, and it also fits the Australian culture called Great Australian Dream. So like that's the desire for every family to own their own home, because we all know that like a man's home is his castle. So like the property here is not just an asset. I think it's a security. Yeah, so like it's provide emotional security and also proven historical growth in value for the investors. And the second one is the rental income. It's like property, like commercials or residential, they generate consistent rental income, which can cover SMSF expenses or even like pensions in retirement. And unlike dividends, which mostly like depend on the corporate profits, the property is less speculative. Yeah. And it's tied to the growing housing demand these days. So like in general, I think it's true. Yeah, it's true that equity offers the liquidity and the tax benefits like franking credits, but the property delivers like the stability and the cultural trust and also like the steady income. And those are like something retirees really want and need. Like the property is not just an investment, but our team against team believe it's like it's more like a long-term cornerstone of the retirement security.
They will tell you property is the safe option, but that is yesterday's story, not today's reality. Tax asset came under very different conditions. Low interest rate, bank competing for SMSF loan. Today's most major banks have decided SMSF lending. We remember the winner of last generation, but those outcomes are not repeatable. That survivorship bias. SMSF loan now sit around 6 to 7%, while rental yield averages 3 to 4%. That means the property inside your SMSF leaves cash every year. And unlike outside super, you can't offset those losses with negative gearing. Properties can't be sold quickly to meet pension payments or under unexpected expenses. In contrast, equity and ETF can liquidate it in seconds. Liquidity is survival, and property inside an SMSF fail the test. So if property is supposed to be safe, it's safe from growth, safe from income, and safe from liquidity. That is not security. That is stagnation.
As Kane mentioned in the long-term high returns of equities, when comparing equity and property, I believe property offers a more stable and reliable SMSF investment. Equity investments, such as shares, tend to have high volatility in the short term. Their values fluctuate sharply due to daily market movements, economic uncertainty, or investor sentiment, making them stressful and unpredictable for conservative investors seeking long-term security. In contrast, property investments are generally less volatile and more tangible. They can generate steady rental income, and their value tends to grow gradually over time. That's why property is often seen as a safer, more conservative-friendly option, allowing elderly investors to plan with confidence, knowing that short-term market swings will not significantly affect their long-term returns. In short, property provides stability, consistent cash flow, and peace of mind, advantages that equity often struggles to match.
So with equity, you can earn a higher return at a lower cost with more liquidation options, and in terms of tax, you actually earn from it. And all these equity volatilities that the property supporter says can be mitigated by having more asset opportunities or having a customized balanced portfolio. And instead of waiting like 6 months on a burning housing market like it's 2008, and at the end of the day, if you want to retire with an SMSF, equity give a higher return, a better risk to reward ratios, and more options on how you can control your investment.
Yes, so it's not false that equity promises liquidity and tax benefits, but it's speculative in the short term, like the daily fluctuations based on the market news, politics, or like the global events can quickly erode the investor confidence. And for investor, that volatility is not just stressful, but it's like also can threaten their pension security. And moreover, let's not forget that like the dividends, they are not guaranteed. They can be cut during the downturns. And while the property, like on the other hand, it offers the emotional safety. It's like it's stable, it's tangible, and it's tied to the basic need. So like making it more resilient and reliable as a retirement asset. And overall, I think like the main purpose of an like SMSF symbol to give you something secure when you retire. And retirement, importantly, like retirement is about peace of mind. It's not like you're seeking the volatility. The point here is that that is something that equity cannot guarantee, but property can. Property can guarantee that. And also, when you're closer to retirement, like the what matters the most is not like running after the market, but I believe that you have to knowing your nest egg is safe. I mean the thing, your asset is secure.
In conclusion, investing SMSF funds in commercial property provides a powerful combination of financial efficiency, stability, and growth potential. It allows investors to convert rental expenses into long-term wealth through the business premises strategy, while also benefiting from Australia's strong and consistent property value appreciation. Moreover, because property is a tangible asset, it offers easier access to financing at lower interest rates, creating greater leverage opportunities. Altogether, property investment through SMSF not only builds financial security, but also ensures sustainable growth, making it a far more strategic and resilient choice compared to equity in the long run.
And now I will conclude my main point. So when we think about retirement, the core needs are actually really simple: is stability and income. So the first one, stability. Like shares and ETFs rise and falls daily. What does mean this? So it's like it fluctuates every day, right? It can be rising in one moment and then falling the next one. But on contrast, the property moves more slowly. So that steadiness like offers the retirees confidence. So making it a reliable asset so that the retirees, the investor, they can truly trust in the property. And the second one is the income. Property like residentials or commercials, they will offers a steady and predictable rental income. And those cash flow can cover SMSF expenses and later the pensions without like depending on the ups and downs of the corporate profits. And when we put together the stability and the income, that equals the retirement security. Yeah, the security. And the most important thing is that the property is offer those both pillars, stability and income, but not the equity. The equity cannot.
Property should consider is that rental income is usually overstated, and most of the time property owner assume 0% vacancy rate or too low compared to the market standard, And in addition, they do not account turnover and it associate cost of maintenance. And they can also assume a draw-only rate, which can affect vacancy rate and the eventual cash flow, creating hype and potential over leverage. In addition, property is only affected with low quantities, so meaning when growing, there are costs to consider, like repair maintenance across different property characteristics, and there are also the cost of management, legal, and the council rate that you need to pay when you scale up. So for this, actually further cut down the actual profit that property supporter claims.
We have shown that equity and ETF deliver high return at lower cost with broader diversifications than property inside an SMSF. The numbers are clear and the risks are undeniable when it comes to your retirement saving. Why gamble everything on one property? Equity and ETF are smarter, safer, and similar way forward. But we want to hear from you as well. If this were your SMF, would you bet your super on share or property? Your answer will tell us where the future SMF investing truly lies. Thank you for listening.